Sanjay Mookim is a market master today, strategist, head of India Equity Research, JPMorgan India, and he's with us. Sanjay, good morning. Great to have you with us here on the program. It's always a pleasure. Prashant this side. Sanjay, the first, two-part question. One, do you think, we all know it's bad out there, it's obvious, I mean, it's all, and we're seeing it around the world, but the market here in India in rupee terms is already down about 11%. And I think after today's fall, about 11-12% from the highs. Consumption has been weak since the second quarter. I mean, earnings growth, etc. Markets are essentially forward-looking animals, right? I mean, it's not about where things are now, but where things will be, say, 6-12 months out. So in that sense, put the markets in context to what we are seeing in terms of news flow and macros right now. Go on.
Good morning. Great to be on. I think there's two things which are driving the to term it in this terms, excitement in the market. One, of course, is global uncertainty. You've seen VIX indices going up everywhere. US bond yields are almost in touch of 5%. And that's a reflection of the uncertainty on the change in policy in the US, whether you get rate cuts or not, what actions are taken by the new Trump administration. And whether we like it or not, these do have implications for Indian equity markets. As a measure, momentum stocks or momentum as a style is doing poorly almost everywhere. High duration growthy stocks are doing badly. So that does have a rub-off in India. And to your point, Prashant, how does this play out? This is very binary, right? It depends a lot on what action is taken once the new administration is in place. But call it 6 months from now, we will have a fair view on what is happening, right? What is affected, what changes are made, and the implications of that. Right now, we're living in uncertainty. The second, which is a more domestic phenomena, is earnings momentum, which was very strong in 23 and early 24, but now has actually come off quite a bit. And we don't expect that to change too much. We think, yes, it will get a little better from where it will be in December. Purely on base effects, the June quarter should start to look a little bit more better. But I would argue that we are in for a period where it becomes a little bit more nuanced. Everything goes up rally is probably at an end.
Sanjay, hi. Morning. Tough morning,
Hi.
really. I was now, on days like this, you start extrapolating back and see when was the last low and all. And I just realized that we've broken our November lows. And now I don't know. I mean, the chartists were talking about it. I remember one chartist made this point that we could retest the lows that were made on the day when we got the general election result. That, 1,100 point swing down and then the rebound. And that was around 21,200 thereabouts. So who knows? But the problem is, Sanjay, that it's turning out to be a bit of a perfect storm. You have all these global issues, Fed rate cuts, tariffs in the US, uncertainty of policy, as you said. And then we have local issues in terms of the earnings trajectory. So let's talk about your assessment there. Whether this slowdown is transient. We were just speaking to an FMCG analyst at Goldman Sachs just before the call with you. They, for instance, are hopeful of a recovery on urban consumption. Where are you when it comes to earnings this year?
Well, we're all hopeful of some sort of recovery. The December quarter doesn't look that well placed, to be honest. Our base case estimate is for low single-digit earnings growth for the Nifty. But more worryingly, what happens the December quarter typically is full of downgrades, right? You typically see large earnings cuts, and that's because analysts catch up to their full-year forecast once the 9 months are over. So I don't think the momentum will change too much. But more fundamentally, what you should start to see, hopefully, is the impact of the rains that we saw last year and good monsoon spread showing up in rural incomes, at least partly as the harvest rolls through. So there is hope that you should start to see a little bit of an improvement in the mass market consumer outcomes. But again, we've been crying wolf on this for so long that I think only once we get it will we have any bit of visibility.
Just to clarify on the earnings numbers, Sanjay, you said single-digit earnings for Q3 or was it FY25?
So Q3, we expect single-digit earnings growth, but for 25, we think we'll get around 10-11% EPS growth.
Or 10 to 11%. And too early maybe to ask you, but do you have some numbers for FY26 as well, as of now, from where we stand?
Sorry, I meant CY25, 11%, that's roughly.
Okay. So 11 to 12% for CY25. That's the earnings trajectory.
That's right.
Got that. Thank you.
Which recovers to mid-teens in 2026? That's what you're working with?
Well, I think it's a bit too early. When I say CY25, it's effectively FY26. I think we haven't gotten as far as forecasting FY27 yet.
Got it. All right, Sanjay, but weakness like this gives you a good opportunity to get into stocks that you could be, bullish on and prospects look good. Could you, name a couple of themes? I recall in the past we've spoken about the real estate space. That had the momentum. That's done quite well as well. Staples, they've been underperformers, but maybe under-owned as well. What do you like at current reckoning, the top two themes?
Well, we like real estate, we like the power sector, we like financials structurally because, look, that's the one space where you get a combination of decent valuations and hopefully good long-term dynamics. We currently are underweight materials and some select consumerish names, perhaps. But I think, look, if you try and say that, look, this correction is providing me opportunity, that's effectively a call on valuation, right? Where have valuations become reasonable? And if you use that filter, unfortunately, it's only the financials that pop up even today.
Mm-hmm. But Sanjay, the financials actually, though the valuations look very yummy, you look at that ratio of banks and IT, and that's gone to the extreme that we've seen in multiple years because IT has done very, very well, while the Nifty Bank has underperformed to such a large extent. Though valuations are attractive, it seems the selling pressure continues out there. But do you believe it's come to that juncture? Well, now, in fact, you need to start loading into some of these financials because some of them are trading at valuations that we saw even 3-4 years ago.
Well, if you take that same chart, the banks versus IT, and extend it to a longer period of time, take let's say a 10 or a 15-year chart of banks versus IT, you'll see you come to a very different conclusion, to be honest. Right?
Indeed.
Banks have outperformed IT for a very structural basis, and that's how it should be. It's a domestically facing business versus something that is facing an external environment. And I don't know about the timing, whether now is the time or not, but on a valuation differential, it does look compelling.
Real estate, financials, power, underweighted materials, and select consumer stocks. I mean, that's basically broadly the view which is coming in. Sanjay, is it just with the budget around the corner, right? Any thoughts out there? Can the budget be a little market friendly, or do you think it's unlikely? There was an election recently, so what's really the need? And the problem, though, is while the slowdown is older than all this global recent stuff, any help has to be done in this global context, and the global context is a little adversarial. So what's your sense, Sanjay?
Well, I'd say, look, we are entering a sort of slightly different sort of dynamics for the government. For the last 3 odd years, we were in a period where revenue growth was very, very strong and subsidy bills were well contained. This is the first time where you're seeing some pressure on revenue. And remember, for FY25, we've had a very strong dividend from the RBI, right? And that may or may not be repeated next year, we'll see. But you are looking at a situation where the government will have to be careful about its revenue projections, whereas subsidies, let's say, on food or on LPG are going to exceed estimates after many, many years. So you're getting into an environment where, again, you have to make choices, where there are constraints popping up. And as a result, the broader theme is let's not expect any major sort of stimulus, because my guess is the government will want to stay on its path of fiscal consolidation. And if not fully to 4.5, they would want to bring deficits down a little bit further in the next budget as well. So you can look at minor changes, but I don't think we're in a situation which calls for a major dilution of the deficit target.
That's interesting, Sanjay. So in that 11 to 12% earnings projection, you're not expecting or baking in any major fiscal bonanza. Let's talk about monetary. I mean, the world over, the trade is now coming down to the reality and realization that the Fed will not be very charitable this year. Let's talk about what you're expecting on the monetary side, because, I mean, earlier the market was expecting the whole rate cut cycle to start in India. But I'm wondering, with crude oil prices elevated 5%, rupee doing its own thing, I don't know how charitable the RBI can be. What's your expectation there?
Well, there's two facets to it. One, we still pencil in a couple of rate cuts from the RBI for this year. But your point is very valid. It will depend a lot on how the external environment shapes up. If you get tariffs and EM currencies start to move in response to the tariffs that are imposed, then you will have pressure possibly on the Indian rupee as well, and that will change the outlook for what the RBI can do on local rates. The second measure is the control on credit flow. on liquidity as well. And maybe the RBI can be a little bit more generous, and all the measures that have been put in to constrain lending could have been pulled back. But do we see an environment where the RBI brings in too much of surplus liquidity? Probably not just yet. We will, again, to your point, it depends a lot on how the external environment shapes up.
All right, Sanjay, appreciate you joining in. Thanks a lot for joining in. Looking forward to having more chats with you in 2025. The screen is looking a little bit jittery, but sometimes there are plenty of opportunities that do crop up. Just one